This is Rick Cortez. I am CEO of Broadmark Asset Management, and this is the Westwood Broadmark Tactical Growth Strategy Update for October 2023. And today I'd like to discuss with you our most recent model change. Since the beginning of the year, there's been a conflict between the fundamentals and momentum in our work. The fundamentals have been negative, while momentum has been positive. This changed in September. Our momentum models went negative, and therefore we have taken a maximum defensive posture. So what triggered this? The first chart shows the breadth of the S&P 500 industry groups so far this year. And as we can see, this has turned negative for the first time since the beginning of the year. The second chart shows money flow into and out of the market as measured by up and down volume or supply and demand. This too has gone negative. And the third chart shows the results of this defensive posture during September, whereas our strategy has remained relatively stable. The S&P 500 dropped almost 5%. Does this mean that we are going to take short positions in the near future? But we go to a defensive posture in order to protect the portfolio. The use of short sales is an aggressive move, which we would use only in major declining markets in order to achieve positive returns during those declining markets. We did so in 2008. We did so in 2002 successfully, but only 4 times in the last 15 years have we gone short. In fact, during the 2020 pandemic, while we were largely in cash during that 34% decline, we never took short positions. So what's next? Well, if you've heard me say this once, you've heard me say it many times, we do not predict stock prices. We adapt to the market environment. Now, that said, if the 4 pillars of our process remain negative, we may indeed take short sales. However, if momentum gets positive, we will reinitiate long positions. Looking ahead, if valuations were to decline to more reasonable levels, if investors got really pessimistic, and if the Fed started to ease, that would make our fundamental models positive. So the fundamental factors would be positive, but we would still have to wait until momentum turned upward before buying. And here's why. This chart shows what happens following the first Fed rate cut in Fed tightening cycles. And this chart goes back to the 1970s. Those blue bars are the maximum decline in the S&P 500 following the first rate cut. As you can see, the first rate cut often leads to the most dangerous time for stocks because the Fed is cutting rates in order to fight a recession. So in summary, even if our fundamentals were to turn positive, we would have to wait for momentum to turn up in order to buy. And the reason for this is don't try to catch a falling knife. So this is Rick Cortez. Thank you for joining me. Please join us for our November update next month. Thank you.